Hi, I'm Jimmy. In this video, I'm going to walk through some different ways we could protect our portfolio if we believe a stock market crash is likely to happen. Now, there are a few different ways to hedge a stock portfolio, and the one we choose, or the combination we choose, is likely to be based on a couple different things. First, our risk tolerance, and then our confidence or the likelihood of a stock market crash in the near future. Okay, so the first very real possibility is not to hedge at all. Let's imagine that we have a portfolio that we're dollar cost averaging in. And dollar cost averaging is when we buy a given dollar amount, the same dollar amount, at different time periods. So let's say every month or every quarter, we invest the same amount. Well, this strategy alone is a way of hedging in its own right, because if the stock market falls, well, you just buy more shares at a cheaper price. So if that's the case, we might not need to hedge at all. But let's say we want to be a bit more strategic than that. What can we do? So I'm going to walk through a couple choices, and beyond just mentioning the strategy, I think it makes more sense to look at how each of these would have performed in actual stock market crashes. That way we can determine which one will help us most in our portfolios. So let's start with adding defensive holdings to our portfolio. Now, oftentimes this can mean adding holdings that are typically thought to do well in down markets. Defensive industries like utilities, healthcare, or consumer staples are believed to do well in a down market. Bonds are often considered quite defensive as well. So how about we start by looking at both the Great Recession and the tech bubble to see how each of these groups performed in those time periods, and then we'll jump on to other portfolio hedging ideas. So this is what the S&P 500 did in the early 2000s when the tech bubble happened. And as we can see, this is a high and this is the low. So how about we switch up this chart to just start at the very highest point and end at the lowest point. Now this is what that chart looks like. Now you may notice that I have this chart scaled starting with 100 value. And you may notice that the S&P is down here at the bottom at 52. Well, that's because the S&P during this time period was down about 48%. So 100 minus 48, you end up with 52 value. Okay, now let's start with some comparisons. So this is consumer staples. And as we could see, consumer staples did significantly better than the S&P 500 did. The S&P 500 was down about 48%. Consumer staples were down like 3%. Now, all these numbers are in price returns, meaning that they don't account for dividends. So the S&P was only down about 46% if we assumed that all dividends were reinvested back into the index. And the consumer staples, for this I use the ETF XLP, and that represents the consumer staples ETF. And they were only down about 0.5% if you accounted for dividends. Okay, now switching over to healthcare. So we can see that healthcare did in fact beat the S&P 500, although it wasn't as good as consumer staples. When accounting for dividends being reinvested, well, XLV, that's the healthcare ETF, they were down about 18%, while the S&P 500 was down about 46%. So they did good, but not as good as consumer staples. Okay, moving on. Now we jump over to XLU, which is the utilities ETF. And XLU was down about 26%. Yes, it was better than the S&P 500, but not as good as the other two ETFs. Now, I should point out, when we look at this chart, we can see a huge difference between the two lines. And one of the primary reasons for that is that utilities tend to be good dividend payers. And we can't forget that this is a price chart. So they were really down about 33% on the price chart. But when we consider the dividend perspective, they were only down about 26%. Okay, on to our last category, investment grade bonds. Now, I actually couldn't find an investment grade bond ETF that was trading back at this time. But today there is LQD. And interestingly, the index that LQD tracks, which is called the iBoxx Liquid Investment Grade Index, well, they did have data on their performance for this time period. So that's what I ended up using. Now, if we fast forward to the Great Recession, well, this is the S&P 500 from the top in October of 2007 to the bottom in March of 2009. So when we compare this to the consumer staples ETF, well, once again, the consumer staples ETF beat the S&P 500, and the S&P 500 was down about 55%, and XLP was down just about 28%. When we switch over to healthcare, well, we can see that healthcare did outperform the S&P, which would in theory mean that it would work as a hedge for our investment portfolio. Now, XLV was still down a total of about 37% during this time period. So yeah, sure, it would work as a hedge, but it wasn't really a great hedge. Now, when we switch over to utilities, well, we can see a very similar story. They beat the S&P, so that's good. But as an investment hedge, I'm not sure it worked all that great because this XLU, well, it was still down about 41%. So sure, it was a diversifier, but it wasn't a great one. And this brings us to investment grade bonds. Now, this time, LQD was live. LQD is an investment grade bond ETF. So it looks like they were down about 11% during this time period. And that is true on a price basis. But since they paid pretty good dividends, on a total return basis, they were down about 4%. Now, to me, that's much better. If somebody had told us that we could invest at the top of the market and the market would be down more than 50% and we would be only down about 4%, personally, I'd be fine with that. But can we do better? So one popular portfolio hedging technique is to use gold. But does gold actually work as a hedge? Well, this is gold during the tech bubble of the early 2000s. And yes, gold held up quite nicely, up about 13%, as the S&P fell just short of 50%. When we switch over to the Great Recession, once again, gold did excellent, up about 25%, while the S&P 500 was down more than 50%. Now, I do want to point out one fact about gold as a hedge. Yes, it tends to be a very good hedge, but not for many of the reasons that we often think it is. It's not really tied to the stock market at all. Instead, it's really tied to currencies, specifically the US dollar. So this is gold versus the US dollar during the Great Recession. And as we could see, they often move opposite of each other. When the dollar goes up, gold goes down, and vice versa. Well, why does this work as a hedge then? Well, during recessions, the dollar tends to weaken, which is usually a good thing for gold. Now, this isn't perfect every time. It doesn't always happen that way. In fact, the International Monetary Fund estimates that about half of the movement in gold is explained by movements in the US dollar. So it's not exact, but I just wanted to bring this out as a point for something else to consider. The real main point here is that yes, gold tends to work as a hedge. Okay, now on to our final hedge, and that one is using stock options. So there are a ton of different ways to use stock options as an investment hedge. Now, options can be a bit more advanced, and we really need to be sure that we're comfortable using stock options before we go ahead and put our hard-earned money to work. Two very good stock option strategies are called protective puts and covered calls. Now, I actually have more in-depth videos on each of these topics, and these are really some of the simpler of the option investment hedging strategies. So if you're interested in learning more about either one of those, I have links in the description below for those two videos. So to keep this video from getting too long, I'm just going to very briefly summarize these two investment hedging strategies. If you're interested in seeing more options-related videos, let me know in the comments below, because I'm actually a huge fan of options and it's something I studied a lot of and I really like them. So if you want to see more of those, let me know in the comments. But basically, covered calls are good if you want to grind out some additional income for a stock or an ETF that you already own, while protective puts are good because you don't have to own the stock or the ETF and you make money if that falls. But they can get a bit expensive if you want to buy them for long periods of time. So my opinion is the smartest thing to do is to keep a diversified portfolio. Adding some gold could make sense as a hedge, and adding some bonds would also probably help the portfolio a lot. Now, I used corporate bonds in our example because they have the added perk of paying out semi-annual income payments or dividend payments, similar concept, and this could be a good thing for our overall portfolio. Now, if we wanted to add some options to the whole mix, well, that could be a bonus if we know what we're doing with them. So what do you think? How would you go about protecting your portfolio if the stock market crashes? Would you protect it at all? There's lots of choices, and there's many different ways to do it based on the way our portfolio is currently set up. Let me know what you would do in the comments below. I'm very curious to hear everybody's opinion on this. Thank you for sticking with me all the way to the end of the video. If you haven't done so yet, please hit the subscribe button, hit the thumbs up. I'll see you in the next video. Thanks.